Without further ado, I would like to pass on the floor to Howard and Teresa. Okay, thank you.
So thank you for the invitation from CFA, Kaya, and also Octree. And then it is really my great pleasure to be here with you, Howard, after reading all your letters over the years and the books. So I'm sure everyone here today, like one of the most important things that they want to know from you is how you think about the market and your investment advice. But maybe before we dive into those questions, let us know more about how you sort of approach the market. And you currently have the new book, Mastering the Market Cycle, which is, I think, very timely, as every one of us right now is trying to figure out how to see the market cycle. Maybe tell us more about what you think about market cycles and how do they impact investment decisions.
Thank you, Teresa, and thank you very much for doing this for the benefit of the audience. Back in 2011, I wrote a book called The Most Important Thing. And it has 21 chapters, and each chapter says, the most important thing is, then it's a different thing. Because in investing, there is no one most important thing. There are many things which we must consider, and all of them are essential. Having said that, I do think some things are more important than others. And to me, the most important thing in investing is risk. And the first book has 3 chapters: understanding risk, recognizing risk, and controlling risk. And I believe that the mark of a great investor is not merely good returns. It's easy to make money in the market, especially in good years, and most of the years are good years. The real qualification for being a great investor, in my opinion, is to be able to make money in the great years and not give it back in the bad years. And in order to do that, you have to be able to invest with the risks under control. And you do very well in the good years, and you don't give it back in the bad years. And in this way, the great investor has very good results, but also low volatility and good performance in the bad times, so that he and his clients don't get scared out of the market. If you want to invest with the risk under control, it seems to me one of the most important requirements is to understand where we are in the cycle, because I believe that where we are in the cycle is extremely influential in determining risk. I think that when we are high in the cycle, the risk is high, the expected return is subpar, and it's hard to make money and it's easy to lose. And when the market is low in its cycle, the reverse is true. The expected return is higher than usual, the prices are low, the risk is low, and the opportunities are high. So I think that the riskiness of investing is not the same all the time. The riskiness of investing changes dramatically, and the primary determinant of whether the market is risky or safe is whether it's high or low in its cycle.
Thank you, Howard. So I think what I got is you are suggesting investors, say, take a more conservative stance when you think it is late cycle, and maybe more aggressive when after some dislocations and you see a loss of risk aversion in the market. So I think I'm sure we absolutely agree that, but I would presume also that a lot of investors in the asset management industry, they sort of understand this fundamental principle, like this kind of golden rules. But why do you think like sort of investor not behaving like sort of sticking to those rules and sort of deviate from this kind of like the fundamental principle?
I think the main issue, Teresa, is, as with many things in investing, it's not easy. And it's easy to go astray. I'm a value investor. I try to figure out the intrinsic value in a situation. I like to buy if the price is low relative to the intrinsic value. I like to sell if the price is high relative to the intrinsic value. What is the main determinant of that relationship? It's emotion, psychology, investor sentiment. If people are excited and bullish and optimistic regarding to the asset, chances are its price will be above the intrinsic value. And of course, that is a source of danger, and that is a source of below par returns. But if the investors are pessimistic and unexcited and have given up on an asset, then chances are perhaps that its price is languishing low relative to the intrinsic value. And that is a source of great opportunity. So we want to buy when people are depressed and pessimistic, and we want to sell when people are optimistic and excited. The difficulty is that many people's emotions or psychology, I use the terms interchangeably and it's not easy to say why, most people's emotions fluctuate the same. We're all subject to the same influences. We all read the same headlines. We all hear the same stories on TV. We all see the same economic reports. So the things that get other people excited and positive and optimistic would tend to get us excited and positive and optimistic. So the things that force people to bid securities up and make the prices high, those same forces would tend, if permitted, to make us excited and to buy when prices are high, and depressed and to sell when prices are low. So the point is that if your thinking and your emotion is the same as everybody else's, then you cannot do the outthinking and what I call the second level thinking, which is required to act against the herd. The common word is contrarian, and to sell at high prices, which are high because other people are optimistic, and buy at low prices, which are low because other people are depressed. We have to be aggressive when people are depressed and defensive when people are excited. In other words, we have to think and feel differently from others, and that's not easy. We have to be either unemotional people, or we have to learn the importance of emotional restraint and how to do it. And these things are not easy, so most people are unable to do it. You know, there is proof that most people are optimistic at the top. And the proof is that it's a top. The proof is that the prices are higher than ever before. That can only happen if optimism predominates over pessimism. There's proof that people are depressed at the bottom. And the lowness of prices is the proof. Prices can only be that low relative to intrinsic values if most people are depressed. So we have to be excited when they're depressed, and we have to be defensive when they're excited, and it's just a hard thing to do. And let me, I know you're ready to speak, but let me say one more thing. One reason it's hard to do this is because there are not many opportunities to do it well. I was talking to my son. Those of you who read the memos know I reference my son in the memos from time to time, Andrew, and we work together on investments. And I was working on the book, and I said to him, you know, I really think that essentially my market calls have been correct. And he says, yes, Dad, that's because you made 5 market calls in 50 years. And it's true. If you wait until there is a market extreme, when it's really high or really low, and you make your calls on only those occasions, I believe that at those times, the error of the cycle is obvious, and if you reach that proper conclusion, it is highly likely to work. If you're impatient and you try to make market calls other than at the extremes, I think that the logic will be difficult, and I think you're unlikely to be able to do it often. So the things I recommend in the book will not work weekly or monthly or annually. They will only work at the extremes, and if you know, most people don't have that kind of patience, and they try to make the calls more often, and when you're not in the vicinity of an extreme, they're not going to work. Those of you who read the first book know that there's a chapter which says that the most important thing is patient opportunism, and I think the last sentence says that when there's nothing clever to do, the mistake lies in trying to be clever. So trying to make these calls other than at market extremes is a mistake. You don't get to do it often, but if you do it at the real extremes, it's extremely profitable, and you don't have to do it often to have it make a real addition to your investing record.
Yeah, I was actually just going to ask, is there anything like on your daily life that help you to train your patience and your emotional, like make you more emotionally restrained? Yeah, just curious.
Investing is a challenging field because investing consists of dealing with the future, positioning our capital to have an optimal future, even though the future is not knowable. The future is unpredictable, and the future is beset with randomness. And has anybody here read the book Fooled by Randomness? A few heads are nodding, and I think it's an important book, and I think it's important to understand the nature of randomness, among other things, to understand how unpredictable the future is. And I think that it is important to acknowledge that. In the investing business, there are a lot of people who think they can predict the future. Perhaps more importantly, I believe, there are a lot of people who think it's their job to predict the future. And there are people who believe that if they say they can't predict the future, then they'll lose their job. You know, there are people who feel that if the client comes to you and they say, so what is the market going to do tomorrow? And you say, I don't know, which is the only right answer, then they'll say, the nightmare is that the client will say, well, I'm going to go down the block because that guy told me he does know what's going to happen tomorrow. And we're all afraid, I shouldn't say we're all because I'm not, but many people are afraid that if they acknowledge that they can't predict the future, then the clients will go to the people who claim they can. And so I think it's, you know, some of them, there are 3 words which are among the most important words in our business. I don't know. And if you don't know something, and there's a lot we don't know, you should admit it to yourself and to everybody around you. And I think personally that it's very freeing to say, I don't know. I think it's very almost depressing to feel that you have to have an opinion on every subject, even the ones where by definition you can't have superior knowledge. And so I think that people make too many judgments in a world in which those judgments are unlikely to work. And I'll end on this question with a quote from Mark Twain, who was one of America's great humorists. And Mark Twain said, very importantly, for everybody in the investment business, it's not what you don't know that gets you into trouble. It's what you know for certain that just ain't true. And if you think about it, nobody ever got into big trouble by saying, I don't know. The way you get into big trouble is by saying, I know, and betting heavily on your opinion and being wrong. So if I have to drive, which of course the thought of driving in Hong Kong would give me a headache, but if I had to drive from here to Macau, and if I say, you know, I don't really know how to go, then what would I do? I would ask directions. I would turn on the GPS, and I would get a map, and I would drive slowly in order to make sure I don't make any wrong turns. And chances are I would get there eventually. But if I say I know, then I'm not going to get directions or a map or GPS, and I'm going to drive fast because I'm confident, and I probably will end up in Beijing. So it's saying you know when you don't know that causes the problem in our business, and acknowledging the fact that you don't know is just fine. And most of the time, in the middle ground, we don't know what the implications of the cycle are for future performance.
I think my challenge today is not to ask any question that Howard will say, I don't know. So let's go to today's market. I think, I'm an analyst by background, so I was trying to do some data analysis before coming in. So from 1990 to 2018, you wrote 114 letters, maybe more. And I think you wrote more letters around 2006 to 2008. There were 23 in total, and 10 in 2008. And then there was another cycle around 1999 to 2000 that you wrote more, I think, memos than the other periods of time. And now, 2017, you wrote 4 letters. 2018 so far, there are 3. So from my sort of analysis, so is it your letter, because you call them more cautionary memo, so is this an indication that now comparing to before the global financial crisis, you write fewer memos, meaning that you worry less about the market versus 2017, 2007?
Well, Teresa, that is a very analytical approach. You have me at a disadvantage because I didn't have that data, although I can see how it would be true. First of all, let me say that I try not to write about the current market. And most of my memos are not about what I think the market's going to do in the next quarter or a year. And I'm more interested in writing the memos which are about topics of general importance and hopefully of permanent importance rather than timely as to the short term. But on the other hand, I do think that there probably is an uptick in the frequency of the memos when we are at cyclical extremes, because I think there's more interesting to write. You know, when we're in between the extremes, what am I going to write? I think the market is priced fair. There's nothing smart to do. Nobody wants to read that, and I don't frankly want to write it. It's not. So this is a quiet period. But the more extreme things become, the more I can see the error of extremeness. it's more interesting to me, and I think I can do more of a service for others by pointing out that extremeness. Now, let me just, I'm going to return to that, but let me just say before I forget that now I tend to write 1 1/4. And the main reason I write 1 1/4 is because if I don't write 1 1/4, I start getting letters which says, "Are you still alive?" and I don't want anybody to be concerned. So I try to put one out quarterly. You know, at the extremes, I find it fascinating. And when people ask me which memos I'm most fond of, some of them are on general topics like Risk Revisited Again, 2015, on the subject of risk, Dare to Be Great 2 in 2014 on the subject of being willing to bear risk. But some of them are about cyclical extremes, and of course, as you can imagine, I am proud of having identified some of these things correctly. So, in February of '07, I wrote a memo called The Race to the Bottom, in which I thought I was detecting unwise behavior in the capital markets because the presence of too much money and the inadequacy of risk aversion and the eagerness to put money to work was causing a market condition where dumb deals were able to get done. And companies that should not have been able to borrow money, most of my interest is in the credit markets, were easily able to borrow money. And the deals that were crazily levered and imprudent were finding high degree of acceptability. And I think that this is a great danger sign, easy money for everybody. And so I wrote that memo. Now, most people say, oh, that was a good memo, and it was correct. And of course, it was February '07, and Lehman Brothers went under in September of '08. So it was actually 19 months too early. But, you know, and there's an old saying, the first of the great sayings that I ever learned was that being too far ahead of your time is indistinguishable from being wrong. But nevertheless, I think that, you know, it was important to turn cautious in '05, '06, '07, and it permitted Oaktree to do the right things in terms of selling assets, shrinking funds, raising standards, and especially raising a very large distressed debt fund on a standby basis with which to take advantage of the carnage in late '08. And then bookending the race to the bottom in February '07, I wrote a few memos in October '08, which for a credit investor was the low ebb. October '08 was the time when the credit markets were just falling apart, and the prices of credit instruments were cascading down, and if you had any, you just couldn't sell them because any effort to sell produced a lower price. Now, the prices of credit instruments continued downward through the first quarter of '09, but if you wanted to buy any bargains, you couldn't buy any size in '09. So it was extremely important to recognize the dire straits of the credit market in '08, fourth quarter, and swing into action if you had real money to put to work. And I'm very proud of the fact that Oaktree invested about $650 million on average every week for the last 15 weeks of '08, $10 billion in total. And I think that an indicative memo from that time was one called The Limits to Negativism. And in the memo and in the book, the new book, I recount a conversation that I had with a CIO. We had a levered loan fund, senior loan fund, and because it was levered, it was in danger of melting down. And when we put, when we put that fund into existence, we borrowed money to buy more loans. We had, I think, 4 times leverage, and we could get a margin call if the average price of the loans fell to 85. Now, until that point in time, loan prices had never fallen below 96. So we thought that the risk of a margin call at 85 was theoretical. But the price starts to fall, and it gets down to 96, 94, 92, 90, 88. And so we start trying to raise money. And we raised more money from the LPs in order to delever the fund. And we took it from 4 times levered to 2 times levered. But now, by delevering the fund, we were able to reduce the point at which we would get a margin call to 68. They'll never get to 68. 88, 86, 84, 82, 78, 76. And now we're starting to look at 68, and we're starting to look at a margin call again in an environment where nobody will give you a bid for a loan which isn't a down bid, and which nobody will extend your financing. So I had to go to the LPs again to ask them for more money to delever it from 2 times to 1 times. And I went to this particular CIO, and I had a conversation that produced an epiphany. Because I said, you really should invest in this fund. We have secure financing if we can avoid a meltdown. And the levered yield to maturity on these loans, which we think are money good, is 22. And she said to me, well, what if there are defaults? And I said, well, historically, we've been managing high-yield bonds for 30 years. High-yield bonds are junior to leveraged loans. And historically, our default rate on high-yield bonds has averaged 1% a year. So if you take 1% a year off 22, you still make a lot of money. So she says to me, well, what if it's worse than that? I said, well, the universe average default rate for the last 30 years has been 4%. You take 4 off, you still make a lot of money. And by the way, when you have a default, you usually don't lose all your money. So she says, well, what if it's worse than that? I said, the 5 worst years in the history of high-yield bonds, the default rate was 7% a year. 7 off of 22, with some recovery. Still, obviously, you have a very substantial return in the high teens. And she says, well, what if it's worse than that? I said, well, the worst year in history is 13%. 22 less 13, you still have 9. She said, well, what if it's worse than that? I said, 1.5 times the worst year in history would be 19.5, and if you had defaults at 19.5 every year, not just 1 year, you have to have it every year, you still more than break even. So she says, well, what if it's worse than that? And I said to her, do you have any equities? She said, yes, we do. I said, well, in the world you're pushing me to assume all equities are worthless. You better go out and sell them right now if you really believe what you're pushing me to. So I came out of that meeting, and I remember metaphorically running to my office to write a memo called The Limits to Negativism. And in this memo, I pointed out the irrationality of insisting on these extremely negative assumptions. And what I said was, it was kind of like a revelation to me. For those of us who are in the investment business, one of our essential functions is to be skeptical. And if somebody comes to see you, Teresa, and says, in your capacity selecting hedge funds, if somebody says, I've been managing money for 30 years, I've made between 9 and 11% every year for 30 years, and I've never had a down month, your job is to say, that's too good to be true, Mr. Madoff. And everybody knows that. And everybody knows that sometimes our job is to say, it's too good to be true. What most people don't think about is that that's what happens when optimism is too widespread. What about when pessimism is too widespread. When pessimism is too widespread, then being a skeptic requires us to say, no, that's too bad to be true. And I believe that one of the themes of the book is that we can intuit where the market is in its cycle from the evidence of what goes on around us and the behavior of people around us. So the point is that sometimes people are so pessimistic that no matter what assumption you make, they still say, no, you're not being negative enough. And when there is no limit to negativism, then skepticism requires us to say, that's too bad to be true. And I concluded that that was the condition in '08, and that's why I wrote the memo. And of course, in October '08, all you needed to make money was two things: money to spend and the nerve to spend it. You didn't need caution, conservatism, risk control, patience, selectivity, discipline, analytical ability. You didn't need any of those things. All you needed was money and nerve. And if you had it, you made a lot of money. And if you had those other things, they held you back. And that's what happens when the market is so depressed in its cycle that there is no optimism embodied in asset prices.
So where are we now? Like,
Well, we are not at an extreme. We're not at February '07, and we're not at October '08. I still think we can talk about where we are, even though we can't have much certainty that we're right, or much certainty that the results we think will occur anytime soon. And I'll just switch a bit. I think that for those of you who are portfolio managers like me, or strategists, I think the most important single decision we get to make is whether our portfolio at a given point in time should emphasize offense or defense, aggressiveness or caution. I think that deciding on offense versus defense is more important than stocks versus bonds, US versus foreign, growth versus value, large cap versus small, cyclical versus stable, high quality bonds versus low quality bonds, short duration versus long. Those things will not save you if you're aggressive when you should be defensive, or defensive when you should be aggressive. And I think that if you get the offense-defense question right, all those other things take care of themselves. So I think we can talk about offense versus defense. And another way that you might think about the question that I think is helpful is that I think that everybody in this room, to the extent you're in the investment business, is subject every day to what I call the twin risks. What are the twin risks that affect us? The first risk is very obvious. It's the risk of losing money. What's the second risk? A little more subtle. It's the risk of missing opportunity. Now, if you come to me and you say, Howard, I want a fund from Oaktree and I want to be 100% sure that I can't lose a penny, then I say, okay, Teresa, we'll put you all into T-bills. And you can't lose a penny, but you miss every opportunity. If you instead, you come in, you say, Howard, I want a fund and I want to be 100% sure that I don't miss any opportunities, then I say, okay, no T-bills for you. And now you don't miss any opportunities and you are completely exposed to the risk of losing money. You can't eliminate both risks at the same time. You can eliminate one, which puts you firmly in the grasp of the other. But most of us don't do one or the other. We compromise. Most of us say, well, I don't want to lose a lot of money, but then again, I don't want to miss all the opportunities, so I'm going to be in the middle. I'm going to have some defense because I do worry about losing money, but I'm also going to have some offense because I worry about missing opportunities. So the question is, which one today? Should you balance them in your normal way today, or should you be more worried about losing money than missing opportunity? Or should you be more worried about missing opportunity than losing money? And again, if you can get that right, you have an advantage. So I know you were wondering where I was going. So the question is, where today? And for the last few years, because risky behavior came back in the credit markets, I have thought that caution was more important than aggressiveness. And Oaktree has followed a mantra: move forward but with caution. So we have invested over this period. We have tried to be fully invested, and in general we are, but with caution. We're a cautious firm. That means even more cautious than usual. So we're not going to cash. The decision to go to cash is a very difficult decision. It's very difficult to get it right, and it is a binary decision. You go to cash, you're wrong, you have a disaster, because the market goes up and you're not in it, and pretty soon you don't have any clients. So we are fully invested, a little more cautious than the average bear, which means that if the market goes up, we lag a little bit, but at least we participate. Our increased caution prepares us for a declining market, and I think and thought and still think that it is the right thing for today. So, I would sum up by saying that I would be afraid, I'm a little bit afraid to be in this market. Now, by the way, I say this market. There are lots of different markets. There's a stock market, there's a credit market. There's the US market, there's the Chinese market, there's the Hong Kong market, there's European market. There are so many markets. And obviously no comment can apply to all of them. But on balance, given the age of the economic recovery, the age of the bull market, the reliance of the world on adroit central bank management, the large number of uncertainties that exist in the geopolitical area, on balance, I would say I'm a little bit afraid to be in the market, but I'm almost as afraid to be out of it. So I want to be in it, expressing even more caution than usual.
Thank you, Howard. Maybe before I start to get questions from the audience, I think I haven't heard from any of your interviews, maybe I missed some, for you to talk about the trade wars. So what's your view of, say, a base case scenario of how the trade war will be and the worst case scenario, and how that sort of impact your investment decision?
You know, I think the most accurate thing you can say about the current occupant of the White House is that he's unpredictable. And if he's unpredictable, as I believe, then I can't tell you what the best case or the worst case is, and I certainly can't tell you what's going to happen. I would imagine that a favorable case would be that he continues to, we use a term, it's a little outmoded term, saber rattling. So he continues to rattle his saber and criticize China and other countries as well. He's an equal opportunity rattler. And, but, you know, he continues to speak tough, and China makes some concessions, and he declares victory and goes home. And I think that would be, given the current state of affairs, I think that would be a good outcome. I don't think that if China doesn't make any concessions that he's going to stop pushing anytime soon. So that would be a good outcome. And a bad outcome would be, you know, continuation and escalation. I think that tariffs are not a good thing. I believe in globalization. I believe in free trade. I believe that the world benefits from free trade, and the participants, the countries, benefit from free trade. Now, the challenge is that while free trade, globalization, which permits us to practice, take advantage of our local specializations, is a good thing for the world and maximizes world income, there are still winners and losers. And, you know, they say in America, for example, that there are 3 million people who have lost their jobs to China because China was a more efficient, lower cost producer. And so as long as there are losers, then there are going to be politicians who can make hay by appealing to them. And you know, I don't want to see a further escalation. I don't want to see more tariffs. But when you have an occupant of the White House who is xenophobic and anti-free trade, then I can't specify the worst case.
Some technical help here. I can't open the app. But like while I'm waiting for that, like you talk about White House and the midterm election is coming up. Like your views? Any comments?
I would rather not inject my own personal views in a professional meeting like this, but of course it's impossible not to say anything. I think we have I'll merely say that we have an unpredictable president who doesn't have a CFA. And I don't think that he got top grades at the Wharton School. And I don't think he understands how everything works. For example, one example, of course, he complains that we have an $800 billion trade deficit with China, and he thinks that makes us the United States a loser and China a winner. And I keep telling people that when I go to the barber and get a haircut, I give the barber $10. That doesn't mean he won and I lost. He got the money, I got the haircut. So when we have an $800 billion trade deficit with China, it means that we got $800 billion more of goods than China got from us, and China got $800 billion more dollars from us than they paid to us. Doesn't mean we lost and China won. But anyway, that was an aside. The point is, I think that we would be better off, and I happen to think the world would be better off, if there was some restraint on Trump, some check on his behavior, and Trump is so incredibly popular among what they call his base and among the Republicans that almost no elected Republicans will buck him. And when you see a Republican saying that this is a mistake or that's a mistake or voting against him, the one thing you can be confident about is that it is a Republican who has decided not to run for re-election. I mean it. And there are a few of those. And for example, there are a couple who have voted against him in the past. But other than that, most politicians' job, what's the first priority? What's the second priority? What's the third priority? Getting reelected. And if you're a Republican, you want to get reelected, you don't buck Trump, which means that there is no check on him. I think it's very desirable that there be a check. The check can only come in the form of the Democrats winning the House. So I think it's very desirable that the Democrats win the House of Representatives. The election is 10 days from now. 538, which is the leading polling organization, says, you talk, I'm going to look it up. But 538 says that the probability that that the Democrats will win the House, 83.8%, says right here. So 83.8 is 5 out of 6, and that's pretty good. And I think we should also all take comfort from the prediction that the Democrats will win the House, except for one thing. 538 said on election eve that it was 80% likely that Hillary would beat Trump. So I'm not a believer in forecasts, and that's a pretty good piece of evidence why. Look, if they say that the Democrats are 83.8% likely to win, I'd rather be the Democrats than the Republicans. But I don't breathe easy. So, you know, by the way, the smartest thing I ever heard on the subject of probabilities, the clearest but most intuitive statement I ever heard about probabilities is 2 years ago at the Super Bowl. On Super Bowl morning, they had an ex-football player on TV, and Carolina was playing Denver, I think. And they said to him, "Who do you think's going to win?" Now, this guy he also didn't go to Wharton, and he's also not a CFA. But you know what he said? He said, 8 out of 10 Carolina wins, this could be one of the two. This, to me, is a profound understanding of probabilities. If you talk to the man on the street and you say, well, you know, Carolina is 80% likely to win, what would he say? He would say, well, it's over then. 80% is overwhelmingly. You know, we don't have to worry about the outcome. And the answer is no, they're 80% likely to win and 20% likely to lose. And so this fact, this mere fact, is proof of why there's randomness in the world and unpredictability. Because even when the probability of A is overwhelmingly high, like 80, it's still not 100. And so, but in answer to your question, most people nervously think that the Democrats will win the House. I would say everybody assumes that the Democrats will not enhance their position in the Senate, where the Republicans have a slim majority, and in fact, they have a 2-vote majority in a 100-person Senate now, and most people think that's going to grow to 3 or 4. It doesn't matter. There's no difference between 51-49 and 52-48. But this is the key, and the only thing we have to watch is the House race.
Thank you. So let's go to some of the questions from the audience. So one of the questions regarding future of cycle in your book. You mentioned cycle is driven by human psychology. And with algo trading, AI playing a bigger role in the market, do you see a new pattern in cycle emerging with these new forces?
You know, it's really interesting to me because when I travel around and talk to people like yourselves, and I do this a lot, especially now, of course, because of the book, the questions I get are almost like sociological research. The questions I get the most often tell me what's on people's mind, and in the last few weeks, this is one of the questions I get the most. If it's index investing or passive investing or AI or algorithmic, number one, has this changed the cycle pattern? And number two, has this distorted the level of the stock market? Is the stock market artificially high because of these things? And I think the answer is no. I think that the cycle comes from the involvement of people. I think that people are still involved, a little fewer people than usual. A little more of the money is run by machines rather than people. But I think people are still enough involved to cause the cycle. And by the way, if you think I'm wrong, then tell me why the market was able to switch from optimistic on October 3rd to suicidal on October 25th. And, you know, in one of my memos on the couch, which I wrote in January of 16, I wrote that in real life, things tend to fluctuate between pretty good and not so hot. But in the investment world, we go from flawless to hopeless. And clearly, over the last 23 days, most investors went from flawless to hopeless. First, they saw a perfect environment for growth in which nothing could interfere with the continuation of the bull market, and then 3 weeks later, they saw a market in which there was no good and everything was hopeless. So I think that that the fluctuations of emotion and psychology will continue to dominate and produce cycles. I don't think that the passive and algorithmic investing has made the stock market artificially higher than it should be, because that would only be true if it had caused artificially high capital flows to the stock market, and I don't think it has. Now, things like indexation and passive investing do distort in the sense that, I would call passive and index investing rules-based investing or list-based investing. There's obviously a list of stocks that are in the Forbes 500, S&P 500, and the rest of the stocks are not. And then there's a list of stocks that each ETF buys, and they don't buy the rest. They never say, oh, no, that's on the list, but we're going to buy this because it's cheaper. The machine just buys what it's told to buy. So clearly, what that means, everything else being equal, is that the cash inflows into index and passive funds will cause the stocks on the list to appreciate relative to the stocks that are not on the list, which nobody's going to buy. And so I do think that that is a distortion. And a lot of the ETFs that have been created had, for example, maybe Amazon. And this has probably contributed to the very good performance of Amazon relative to other stocks. And in a correction, if Amazon is over-owned by these vehicles and they have to sell, then there's, of course, the question of who they're going to sell to. And maybe the stocks that have done the best in this period will, in a tougher period, do the worst.
So there are like 2-3 questions relating to success and failure. I think you talk about, in your book, the possibility of success being the cause of failure. So as a very successful investor, how do you avoid your success causing you failure?
Sure. Well, toward the end of the book, there's a chapter called the Cycle in Success. And I do believe that success can be cyclical. Doesn't have to be, but can be. Number one, I think one of the things I say is that success is not good for most people. First of all, success makes a lot of people arrogant and self-satisfied, and nobody wants to be around those people. And number two, when people are successful in our business, for example, what lessons do they learn? Number one, I'm really good at this. Number two, it's easy. Number three, I don't have to worry about risk. Number four, I must be really smart. Number five, I was successful at A, but I can probably do B, C, and D also. And I think those are horrible lessons and dangerous lessons, and they tend to lead to behavior which produces unsuccess. And my general statement on the subject is that success carries the seeds of failure for these reasons, and failure carries the seeds of success. And when a company does really badly, it goes through bankruptcy, and it washes away all of its debt, and it refocuses, and it hunkers down to a smaller nub, and maybe it does better. So I hope you'll read the chapter and think about it. I think it's an interesting chapter, but I do think that success and failure are cyclical. Now, I think the key to avoiding it, the key to avoiding having success make you a failure, is to understand your limitations and to not get carried away with your own brilliance and not develop hubris. And, I'm still in awe of all the things I don't know. And I still respect uncertainty. I still encourage everybody at Oaktree to invest scared. We should be scared of losing money. We should be scared of missing opportunity. We should be scared of making a mistake. We should be scared of not doing a good job for our clients. And I think as long as we are, despite our past successes, it will motivate us to remain a success.
And I think we have only maybe a couple of minutes left. I would like to get your advice. I think a lot of audience here, probably they are experienced investors as well. Some of them may be thinking about setting up their own business. And you have the very successful asset management business. Whenever friends came to ask me, like, the hedge fund friends, like, shall I come out and set up my own hedge funds? Most of the time I tell them, discourage them. Because what I see is running a asset management business is not as easy. It is not just about investment skills. It has a lot of different things to consider. So what would be your advice, like the key success factors on starting a new business?
Well, when we started Oaktree 23 years ago, and I would travel around trying to recruit clients, mainly we tried to go to the clients we had at our old firm and recruit them over to our new firm. One of the questions I got was, well, what has been the biggest surprise? And as you say, I would say the biggest surprise for an investment manager is how much non-investment stuff there is to do. And it's not easy. And you need scale to be able to afford to do it because it's expensive. And so obviously I agree with you on that, Teresa. The other thing that's very important for everybody to notice, and it's a little not so relevant now, but let's say you wanted to start a hedge fund. 10 years ago, I think most people would understate the difficulty of succeeding. Because, you know, if it was 03, 04, 05, 06, the years you lived through, everybody wanted to get into hedge funds. And all you had to do was raise your hand and say, I'll take $1 billion at 2 and 20, and people would give it to you. And if you came from Goldman Sachs, they'd give you $2 billion. And now it's not so easy for a new hedge fund to raise money. Hedge funds in general have been largely discredited. I think the average hedge fund has not given the performance that people were hoping for, and has not given enough performance to justify its fees. So I think it's harder to start a hedge fund now than it used to be. On the other hand, there's a strong desire for people to get into private equity. It might be a better time to start a private equity fund. It might be very easy to raise that $1 billion in private equity. And one thing I wanted to say, because when I said that in an investment firm there's so much non-investment stuff to do, I would just mention John Frank was appointed our managing principal and served in that role from 06 to 14 when we hired our first full-time CEO. But John used to manage everything at Oaktree other than the investment function. And his motto was, managing Oaktree would be easy if it wasn't for the people. Managing people is tough. In our business, everybody thinks they're Warren Buffett and wants to get paid like Warren Buffett, and it is a challenge. So don't start an investment firm unless you're willing for some real challenges. But what I would say is, about being in the investment business or about starting your own firm, don't underestimate the challenges, but do it if you think you'll love it. Now, within the confines of this room, I think we will all agree that the investment profession has been extremely highly paid over the last, I would say, 36 years. Something makes me think that in '82, God looked down and he said, you see that group of people over there? There's a bunch of them in New York, there are a few in Chicago, and there are several in Hong Kong and London. We're going to let them make more than all the other people. And I think that the investment business has been highly paid. One of the things that's going on now with the move towards passive is that some people have concluded that the investment business has been overpaid. It's not going to be as easy to make money in our profession in the next 36 years as it was in the last 36 years. So nobody should go into the investment business because it's the highest paid profession. And by the way, it's probably not anymore. You should go to Silicon Valley if you want to make the most money now. But even if the earnings in the investment business regress toward the mean of all professionals, I still think you should do it if you love it. And investing is a terrific field in which it's never the same 2 days in a row. Every challenge is new. I asked you about if you read Fooled by Randomness, and Taleb talks about dentistry. And he compares dentistry with investing. And he says that if you're a dentist and you fill a tooth correctly every time, it works every time. Not true in investing. You have to be imaginative, creative, versatile, adaptive, and we deal with intellectual problems without having all the information. I find it fascinating. As Warren Buffett says, I still skip to work in the morning. I'm not paid to go to work. Oaktree doesn't pay me a salary or a bonus. I don't have any points in our funds. I only go because I'm an owner and I want the firm to do well. But I love it. And if you love it, my advice is that it's the greatest profession in the world.
Thank you. Yeah, thank you, Howard. Thank you so much.